Charles Harris, upside, reversal, strategy and tactics is what you're going to be learning about in this video. But I want to start here because I think it's important when you're watching a video like this, by the time you get to the end of the video, you've actually learned something. You're investing your time in this video, which I'm extremely grateful for. So I want by the end of the video for you to really understand the concepts of Charles Harris's strategy and his tactics for implementation. So I'm going to show you this chart at the end of the video, asking you these same questions to try and identify them. You might at the minute be able to identify 1, 2, or 3 of them, but by the end of the video with relative ease, I want you to be able to identify all of these points. Now, usually I would start with a different slide, but I'm going to start with this slide because I want to engage you from the beginning. You are going to be learning about all of these things. Pivot breakouts, low pivot breakouts, you may already be familiar with, but Charles's strategy is really focused on upside reversals as a stock is basing and or off key moving averages. So you're going to be learning about the key moving averages that he uses, where he is expecting large operators to step up and support the stocks, the structural framework he is viewing the market as well. So when I'm studying a strategy and I'm studying the person, there's 4 areas of the strategy I want to go very deep on. I want to know in great detail, how do they identify their setups? What specifically are they looking for? How do they go about initially controlling the risk? 3, how do they mitigate the risk? And 4, how do they optimize the profit? So we've got sections on all 4 of those areas, and then at the end we've got a section on mindset. However, I've only included 1 slide on the mindset, and I'm basically telling you at the end of this video, search on YouTube A Trader's Journey by Charles Harris. It is about 90 minutes long and it is absolutely fantastic. Watch that video after this video. It is an absolute must. You will see a couple of MarketSmith charts throughout this video. They're today's video sponsor. There is a discounted trial in the comments section below if you are interested. With all of that being said, let's begin. And we want to begin with a strategy overview. So these are 2 quotes which I think sum up Charles's approach to trading and his strategy. Remember that he was taught by William O'Neill as well, the cancelling methodology, which I'm sure many of you are familiar with. So you'll see a lot of kind of William O'Neill coming through Charles as well. So I think the really big money in the market is made identifying the true big winners, the special high conviction cancelling stocks that have something truly special that can truly change the world. Then capitalize on those moves, which might be multi-year trends. What I do is try and maintain a core position in these types of stocks, but trade around the core by selling into strength when I think the stock is extended and taking advantage of weakness to add to my position or recover shares that I sold into strength. Don't worry, it's all going to make sense. In my experience, buying pullbacks, stocks in an established uptrend is the most profitable and least risky strategy in a bull market. But in a bear market, it's a terrible strategy, which segues us onto this chart here. So this is looking at different market environments. So if you are trading pullbacks or you're in trading breakouts, you would like to be with the proverbial wind in your sails, that tide lifting all boats. So there is a very good quote by Mike Webster, who's a former O'Neill portfolio manager like Charles and a friend of Charles. And he has a quote that nothing good happens below the 21-day moving average. And it sounds very simple, but it's pretty darn effective if you're looking to trade breakouts and or pullbacks. So the red and green areas generally give you a guideline of when the market is either trending up above its 21-day, which is going to be the electric blue line that you see, or trending down below it. So Charles is trying to implement this strategy in the correct market environment for his style. And there's a good quote here by Charles. It's important to have a routine where you actually are looking at the indices every day and really analyzing them and trying to determine, are we extended? Is there distribution in the market? Are we trading above the moving averages and all of that stuff? So the market environment is very key for any strategy, but certainly a strategy where you're actually looking for weakness and trying to buy on pullback. So we're going to start here. And again, this slide is probably going to confuse you at first because you may be like, what are these wiggly lines on the chart? Why have you put black arrows, blue arrows, purple arrows like this? What are these blue dots down here? None of it is making any sense to me. I'm bored. I'm going to go watch Netflix. The Grand Prix is on this weekend. I'm going to go watch that instead. I get it, right? But we've got to start here, and I've got to give you kind of a framework to show you what I think Charles is looking at and why he has developed his strategy in the way he does. So we do that by reps and sets and understanding how do stocks move? How do leading stocks move? There is a very repeatable nature to this. So we're just going to look at NEO, and then we've got about 5 more charts like this. Then we're going to start diving into the details. So Charles is buying on pullbacks, but he's buying pullbacks in what he deems are leading stocks in strong uptrends. And he's looking for pullbacks to key moving averages and all previous areas of support, which we will come on to. And then he is looking for specific patterns to then happen in the market, which he calls upside reversals. We'll get on to upside reversals. You're going to understand everything, but we're just going to start a little bit higher up. And then as the video goes on, we're going to start working into the weeds. As I do these kind of videos, I would recommend watching it twice, because you'll be watching and looking at some of these slides and they won't make much sense here. But when you watch it back a second time and you have a greater understanding of the strategy, of the framework, when you then look at slides like this, you should be going, now I get why those blue arrows are there. Now I get why the black arrows are there. Now I get why the purple arrow is here as well. So what you can see is we've got the black EMA, which is the 10-day EMA. These are all on the daily chart. These are all going to be obviously daily moving averages. So we've got the black line, which is the 10 EMA, the blue line is the 21 EMA, purple is the 50 SMA, the grey is the 100 SMA, and the red is the 200 SMA. For all the daily charts, this is the key for the moving averages, but you will see I put them on multiple slides just for the repetition of things. So you can see that NEO here, okay, builds a very big phase 1 type base if you're familiar with price cycle, and then opens, or it goes into a phase 2 uptrend. Now you can see the stock finds supportive action on some of these lines. Isn't that interesting? And then we want to understand, well, what lines is it finding supportive action on? And then what is happening there? Because we're thinking about, if this is a stock large operators are interested in and are accumulating, they're probably going to be stepping in and supporting the stock. Well, where are they supporting the stock? Is there a repeatable area across different kind of TML, True Market Leader, Can Slim type stocks that they are stepping up and supporting the stock? That's an interesting question, isn't it? So you can see here, multiple times the stock is being supported on the black line, which is a 10 EMA. You can see as it's building this base, see how many times it's finding supportive action as indicated by these blue arrows on the 21 EMA. Interesting. Then it builds another base. Where is it finding supportive action? That's interesting, around that blue line again. Then it starts moving out of the base. Where is it finding support? That's interesting. Tends to be around this black line, which is the 10 EMA. And then it pulls back down to the first time to the purple line, which is the 50-day moving average. That's interesting. Find supportive action there. And on many of these bars that I pointed to, they are upside reversals where Charles is entering a position. Interesting. You're going to learn a little bit more about that. So let's do some reps and sets. So this one here is plug power. You have your initial base breakout here. You can see a couple of times it's actually supported around its black line, the 10 EMA, and then it pulls back down, has a shakeout demand tail near the 50 SMA, bounces, pulls into the 50, bounces, pulls into the 50, bounces, pulls into the 50, bounces. Then we see it has an upside reversal on the 21 EMA here, and then you get the bearish change of character as I elbow my desk up here. That's interesting, isn't it? Let me show you some more. Teladoc breaks out of this base, pulls back. Where does it find supportive action and an upside reversal? You aren't going to know what upside reversals are yet. I know that, but I need to give you the framework for why Charles is then looking for upside reversals, and they are indicative of supporting action around key moving averages where he is expecting large operators to step up and support that stock. So where do you see? 50 SMA, 21 EMA, 10 EMA, 10 EMA, 21 EMA. That's interesting. Let's do another one for Teladoc. So it breaks out of this base. It found supportive action on its 200 SMA, which can oftentimes be an area where large operators step up and support the stock, albeit Charles isn't really looking for upside reversals around the 200 SMA, but it can happen. Tesla in Q1 of 2020 perfectly held around its 200 SMA as well. And then you see 50 SMA, 50 SMA, 50 SMA. Interesting. Black line, 10 EMA. And then we go down. We have an upside reversal and another one around the 21 EMA. We pull down to the 50, upside reversal. 21 EMA, bearish change character. Let's do another one. Here's Tesla, speak of the devil. So as the stock is building its base, oh, here it is in 2020, almost like I planned that. I didn't actually know Tesla was on the next slide, but I did because I put it in there, but I forgot it was there. So Tesla finds support on the 50 SMA, puts in an upside reversal, but fails. Guess what? Every single upside reversal is not always going to be a winner. That's why risk management is really important. Then it pulls back down to the 200 SMA. Oh, upside reversal. And don't worry, I know you don't know what upside reversals are, but we're going to get that. I'm just showing you at the minute, bit of a context, what the leading stocks tend to do. Where do they tend to find supportive action? Can you take advantage of that? This is the premise that Charles's strategy is built upon. Then it builds this big cup and handle. As it's building out the handle, where does it start finding supportive action? This blue line in here, which is what? The 21 EMA. Upside reversal, upside reversal, upside reversal. And you can see there's a bit of, those of you who studied Minervini's work, bit of VCP action. 1 contraction, 2 contraction, 3 contraction. Look how the volume dries up. 52-week highs. What does that tell you? Stock's a leader. Then it breaks out of the base, pulls down, upside reversal on the 10 EMA. Then you get 2 on the 21 EMA, powers up, finds supportive action around the 21. Then look, pulls down to the 50. Then it pulls down to the 50. Interesting that, isn't it? First Solar. Now we're going back a little bit further. Find supportive action on the 100 SMA, which is the grey line, I nearly forgot what moving averages it was, the 100 SMA in here, breaks out of this base, then where do you see that you get the first two upside reversals, which is where price is coming down, finding supportive action and closing strong? 21 EMA, 21 EMA, then it's 10 EMA, then it's 10 EMA, then it tries to find supportive action on the 50 SMA, and it fails. Again, why risk management is really important. Is it starting to look a little bit familiar, a little bit repeatable for how these leading stocks are moving, where they're finding supportive action? If it's not, it really should be. Look at the 52-week highs coming through for M-Phase Energy. Look, as it's building this base, where do you see it's finding supportive action? Around the 50, around the 50, then it breaks out, pulls back around the 21 EMA. Interesting, breaks out, pulls back around the 21 EMA. A shakeout demand tail and gap down reversal bar. You're going to learn about these because what I've tried to do is contextualize Charles's framework in terms of upside reversals, but I like to think of them in terms of shakeout demand tails and gap down reversal bars for games large operators are playing. I'm going to teach you all of that. Then it finds supportive action around the 21 EMA, just underneath. Then it tries an upside reversal to find supportive action on the 50, and guess what? It fails. These things are going to happen. I don't know why there's a random purple arrow in there. That's a mistake. Next one. So let me just go through. Charles was and still is, albeit less so from what I can kind of understand from interviews, an extremely active trader. Okay, he's pretty much looking at the screen the entire time the market is open. It's also his job as well. So there are parts of his strategy which may not suit you depending on work commitments, depending on lifestyle, and we're going to talk about that as we progress. So this is just talking about 1999, which is quite interesting. He was up over 1,000% for the year, but in the first quarter was down for the year, 8%. That's interesting. Never give up. My win-loss ratio in 1999 was about 60%. My average holding period was 7 days. My average gain was 16%. My average loss was 6%. Now, those stats might not seem that impressive, but they resulted in being up 10 out of 12 months. 8 of these months were double-digit months. Of 8 double-digit months, 5 of them were monthly gains of 39% or more. I ended 1999 up 1,031%. Charles took around 700 round-trip trades in 1999. In the trader's journey, you'll see that he actually paid the firm that he works for, William O'Neill and Company, he paid them twice his annual salary in trading commissions. That's how actively he was trading. So he is an extremely active trader, albeit he seems to be somewhat less active now, but things can kind of ebb and change. But interestingly, up 1,000% for the year, but actually down after the first 3 months of the year. I actually find that kind of the most fascinating part of this in terms of just the mentality to just keep on going, keep on going. This was in the margin to count as well. So the next couple of slides are going to be a little bit text heavy, but they have to be a little bit text heavy for you to understand in Charles's own words about his strategy. Then we're going to go on to the visuals with the charts where we can then really start breaking down this text heavy section. So bear with me for about 5 minutes. There's about 3 slides. This is the most text heavy one, but there's about 3 slides that look a bit like this. I will read them out to you, but it's really, really important part of this presentation. If you do want to skip ahead 5 minutes, you miss me reading out, you will still be able to get it, but I'm going to read this too. So these are quotes by Charles. In a bull market, you can trust the pullbacks. Pullbacks will hold at support levels. They hold at moving averages. They hold at prior levels of support on the chart. That's what you can expect. General rules to follow when buying pullbacks, which are applicable for buying strength and weakness. General market in a defined uptrend. Ideally, you should be in a bull market that's strong, uptrending and forgiving. If you're trying to buy stocks on weakness or stocks that are pulling back when the market is topping or trending down, that can be very dangerous because most stocks are not going to find support at those levels when the market is trending down. So remember, we looked at that market environment chart, the red zones and the green zones. Think about the zones for a strategy like this, and which area, green or red zone, is it going to perform better in, i.e. when price is trending up, probably above all key moving averages, including the 20-way. So number 1, only do it buying pullbacks in a strong market uptrend. Not only must the general market be in a strong uptrend, but your stock of choice also has to be in an uptrend. So yes, I'm buying weakness in terms of buying the pullbacks, but I'm buying weakness in the context of a rising stock. The way I define a rising stock and or uptrend is simply price making higher highs and higher lows supported by a rising 50-day moving average. If both of these things are occurring, then your stock is in a defined uptrend and you can take advantage of pullbacks to support levels. You should have conviction in the stock. In order for me to have conviction in a stock, it needs to be fundamentally strong. Think about the William O'Neill and the cancelling criteria. It needs to have a compelling story and great prospects, because when you're buying a stock when other people are selling, when you're taking advantage of weakness in the stock, you're kind of going against the grain, and it takes a lot of mental grit to go against the grain and buy when everyone else wants to sell. So you really need to know what you own and what you have, and have a tremendous amount of conviction. For me, the chart alone, being the technicals, is never going to give me enough conviction to trade a stock. I will never buy a stock on the chart alone. It has to have something that I believe in, and it has to make sense to me why the stock would go up. The stock should have good liquidity relative to the size of your account. It should be fairly easy to buy and sell. You can read the rest of that one, you probably already have. I will go on to the next chart for brevity's sake. So identify. When we buy a stock, whether we're buying strength, so i.e. those kind of classic William O'Neill type breakouts, or buying a pullback, there are two objectives whenever we put on a trade, and that is, number one, we want to increase the odds of winning. We want to put the odds in our favor that the trade will be profitable. And two, we always want to be able to define our loss in case we're wrong. So that's the risk management end part of it. Both of these should occur. We've got a section on risk management, controlling, where I take you through plenty of examples. Typically, I'm adding to a position. I don't initiate as often on a pullback, but if I miss a stock, I will take advantage and initiate a position there on the pullback. So if Charles doesn't get in on, say, the breakout, he could then initiate on a pullback, but invariably he's adding to his position on a pullback instead of initiating his position. So adding on pullbacks instead of initiating on pullbacks is more common, but he will initiate if he missed the breakout, is what I'm trying to say. On disadvantage of buying conventional breakout pivots: higher cost basis relative to buying on pullbacks, competing with others to accumulate shares at obvious buy points when a stock moves above resistance. Every one of us puts alerts at pretty much the same area on a chart when we want to be reminded a stock is about to break into new high ground. To me, this is the obvious place to buy, and the obvious doesn't always seem to work so well in the market. I would say definitely this year, he's talking about in 2021, and even for the past 5-6 years, buying strength has not been the greatest strategy. I've seen more and more breakout failures, breakout shakeouts, and fakeouts become more and more common. So always buying the obvious way, I think, has become more difficult. On advantages of buying pullback, so remember, the stock is still in the context of an uptrend. It is pulling back into key moving averages and or an area of support, such as the high of a prior base. We'll come on to that. Lower cost basis relative to buying at new highs, easier to accumulate shares when the supply-demand balance is moving in your favor. We're taking advantage of fearful sellers who are getting shaken out of a stock at a support level. One more text-heavy slide, I promise you. So on when to buy on a pullback. Prior to the breakout, while a stock is building the base along the right side, so as a stock is basing out. More typically after the stock has broken out and now has certain areas of support, whether they're moving averages or the top of the prior areas of resistance. So i.e. the stock breaks out of the base, pulls back down to the previous high of the base that was resistance. So technical analysis point is you would like to see a prior area of resistance act as support, and that may also tie in with one or more key moving averages. Interesting, we'll come on to that. On buying prior to the breakout whilst the stock is basing. When buying in this way, it's always best to wait for an upside reversal. Appreciate we're now however many minutes in and you're not still too sure what an upside reversal is. Don't worry, we're getting there in the next couple of slides. It's always best to wait for an upside reversal. That's really your indicator of buying a pullback and or multi-day pullback on a stock still basing. You want to wait for the upside reversal because the upside reversal in and of itself indicates supporting action and shakeout of the weak holders. It's preferable that the upside reversal occurs on heavy volume. We'll talk about that later. And always preferable if it occurs on an area of support. But typically within a base that's still building, you might not have those areas of support. Charles is talking about moving averages as well, or potentially pulling into prior areas of support on the chart. The way we define our risk on an upside reversal is our expectation is the stock will continue to move higher after the upside reversal. Just like if you buy a pivot point, the stock should move up. We know we're wrong, that should say, if the stock breaks below the pivot, because that's not normal action. Same thing with the upside reversal. We know that we're on the wrong track if the stock continues to move lower, and that's where we would cut our loss. And that's where the risk management comes in. So if the low of the upside reversal is taken out, think of that as basically breaking the low of the pivot if you were trading through a more conventional breakout. How I would normally trade a stock is using a combination of buying at pivots and buying on pullbacks. I'll buy each successive breakout above resistance to pyramid and each successive upside reversal. One last slide on text, then we're into some charts, thank God. Generally, I'm buying pullback. Generally, when I'm buying pullbacks, I'm looking for something for a little more substantial than a 10% pullback in price. Maybe something in the 12 to 20% range. I'll come on to this in a second. I think the sweet spot, and I did a study, and the average pullback was around 16 to 18%. So if I can buy a stock in that pullback range, I feel like I'm doing pretty well. So what Charles is saying is, imagine a stock as base, it's trended up after the base, and then it's pulling back into, say, the 21-day EMA. What Charles is looking for is for the pullback depth to be around 16 to 18%. So something more than 10%. He's looking for the sweet spot around 16, 18%. Stocks are really tough to trade. They want to trade in a way, I think, to shake out the most amount of people. I always take advantage of the weakness when I have an opportunity to define my loss. The last 3 words there are really, really, really important. So we're going to go through a couple of examples that are still fairly text heavy, but at least we now have some pretty charts, some nice colors to be looking at as we are going through. So we're now going to start talking about upside reversals a little bit, but as we go more and more throughout this presentation, we're going to go more and more and more in depth. That's how I'm trying to kind of structure it. So we started higher up, we're now going into the weeds a little bit, and then we'll be playing in the soil somewhere. So I will talk through these graphics in a minute. If all you did was our traditional buying at the pivots, chances are you've gotten shaken out. So can you imagine if you were buying, see how you break this trend line here? So if you were buying here, okay, you've probably, it's popped for a couple of days and then it's pulled back in, and you probably got shaken out if you were buying in here. And then it comes back up and you get another breakout coming through here, but you've probably been stopped out here. Remember what Charles was said, that the stock is basically trying to go higher with the least amount of people holding on to it. So again, these kind of breakouts, this one here is a little bit kind of V-shaped. This is a little bit better if you maybe got it really, really tight through these kind of trigger bars. But again, these shakeouts are becoming more and more commonplace. So let me finish the quote. You wait and buy at the second pivot point, which is this one here. Chances are you got shaken out again. Are you going to be willing to buy the third pivot breakout, which is over here when it takes out this high? I don't know. A lot of people after 2 losing trades in a short period of time are going to give up on the stock, getting started early and taking advantage of the URs. So URs are upside reversals, just for abbreviating on the chart. In the context of this uptrend, where it's getting support will allow you to have a lower cost basis and allow you to survive some of these short little 1-2 day pullbacks after the stock really starts moving. So this is Lululemon in here, okay? This is an upside reversal, so I'm just going to give you a little indication of what an upside reversal is. If you are familiar with Japanese candlesticks, one of the candlesticks which can commonly form an upside reversal is a hammer type candlestick. So that is basically, you see this bar here, okay? Price opens at this level, it goes down during the day to create this tail. I call it a demand tail because it's demand and it's a tail on the price. So think of a dog and its tail, but there's obviously demand because there's buying, and then the stronger the close, invariably the better. So you can see here that it actually closes on the higher the bar. So these, I call them shakeout demand tails. That's just me and how I kind of think about them, and or gap down reversal bars as well. We'll come on to gap down reversal bars, probably a concept you're not too familiar with, but it'll make sense by the end. So these little kind of shakeout demand tails and recovering are what Charles will call an upside reversal. Even this bar in here, see how price is pulling back down, but the price actually gaps down on this bar and closes on the high of the day. You can see over here another upside reversal. There's actually a little gap down, so this is more so a gap down reversal bar. It gaps down, open near the low of the day, and then closes strong. So a common theme that you're seeing on these upside reversals is price goes down during the session, but then closes strong. As we do more, it'll start making more sense. Here is a good chart for upside reversals. So this is Lululemon. We were looking at it over here. Now the stock's gone up into an uptrend, and like we did earlier on in this presentation, is we were looking, well, where do these leading stocks invariably find supportive action? Either in the context of it's trending up and pulling back in, and or it is rebasing. Where do they invariably find supportive action? Well, the 2 most important moving averages, certainly for the leading TML, so the true market leader, can slim stocks, or the really kind of strong momentum stocks in the market that are kind of mid cap, large cap, mega cap type names. I'm not talking about kind of micro caps and small caps because they'll be more so the 10 EMA, but for these bigger ones, kind of the real TML, the real can slim ones, it's going to be the 21-day EMA and also the 50-day SMA, which on the charts and throughout the charts is going to be the electric blue line and the purple line. So let me take you through upside reversals here, and I'll give you a little visual. So the first one here, you see this UR, so UR means upside reversal. Do you see how this candlestick here looks different to this candlestick and it looks different to this candlestick? So the second and third upside reversal look different in terms of the Japanese candlestick relative to the first one, right? These are what I call shakeout demand tails. You could also think of them as hammer type candlesticks, but I just call them shakeout demand tails. So for me, trying to teach you as best I can, I'm going to refer to them as shakeout demand tails, but they can also be upside reversal bars, okay? So why do I call it a shakeout demand tail? Well, price is going down during the trading session. That's what the tail is on the bottom. Price is going down during the session, but where do you notice the closes? Well, the close is the high of the real body up here. So price is then going back up in the session and closing strong. So an upside reversal, because price reverses to the upside and then closes pretty strong. So you have one in here, then you have another one in here. So see how you get the shakeout, price is going down during the session and then closing strong. This one here is different. So it closes strong, it actually closes on the high of the day, but we don't have that tail. So this is what I call a gap down reversal bar. So the prior close is here, okay? The prior close in terms of, it's really hard to give a price level there, but you see this red real body here, okay? Price closes here, and then the next session for this upside reversal, it closes here, it gaps down, it opens here, just underneath what moving average? Just underneath the 21 EMA, and then closes strong. So gap down reversal bars, I think, can be very effective for upside reversals because it's telling you there's an immediate presence of demand. Why? Because price is gapping down on the open and immediately buyers are stepping in and buying it. And then you have to think about the context of the stop. Where is it basing? Where is price in relation to the moving averages? So a lot of trading is having self-awareness of yourself, but self-awareness to think about the actions of others. So that's why I started earlier on showing you the examples of where are these stocks finding support? 10 EMA, 21 EMA, 50 SMA. That is an area, as Charles is saying, in a strong market environment, you're expecting pullbacks to key moving averages to hold. You're expecting pullbacks to support to hold. Why should it hold? Because you're expecting large operators to step up. So if you see shakeout demand tails around the 21 EMA when a really strong stock in the market is basing, ticks all the canceling criteria, strong relative strength, powerful uptrend, so on and so forth. Well, around the 21 EMA, if you start seeing shakeout demand tails, upside reversals, right? Well, that's indicative that large operators could be here supporting the stock. If you see the first pullback to the 50 SMA hold, that's an area where you'd expect large operators to step up. Are you seeing visually, in terms of the candlestick and the volume, large operators step up and support the stock? Do you see how the kind of framework is starting to come together a little bit? Let's do some more examples. So this one here is playing it all out. You can see the various upside reversals. This is the base we were just looking at. This is more of your conventional pivot over here. You certainly get some kind of VCP type action where volatility really contracts. Look how tight the candlesticks get. Look how the volume dries up. Now I'm just going to wax lyrical for a couple of seconds here on supply and demand, volume drying up, interrelatedness of price with the candlesticks. Bear with me as I go on this one. So can you see here, before this breakout actually comes, you get basically a really tight doji bar, a really tight doji bar, and then two shakeout demand tails, which you could also think about as upside reversals. There's also an upside reversal bar in here. Do you see how they perfectly hold? You get this bar here, which actually gaps down, reverses, then this shakeout demand tail, which perfectly holds the 21 EMA. Now, what's really important with these bars in here is look at the tightness of the real bodies and the spread of the candlesticks. So overall, so high the day to low the day, and the thinness of the candlesticks, and then look at the relative volume. Do you see how volume has dried up below the 30 bar average? So you're getting this basing action and you're seeing large operators, some gains, right? Is it now starting to click a little bit? Gap down reversal bar, shakeout demand tail around the 21 EMA. Large operators supporting the stock. Then you actually build, this turns into a cup and then a handle with some real tightness coming through in the handle. But these multiple tight candlesticks, these little shakeout demand tails, little upside reversal bars on low relative volume tell you what about how much supply is coming to the market? There is sweet FA supply coming to the market, which you really want before your standard breakout. You don't want much supply coming to the market before a breakout. Obviously, why? Because of the supply and demand imbalance. Okay, you are looking for where there is an equilibrium created in the market, i.e. strong hands move in, absorb the supply of weak hands, and then that equilibrium comes in, and then you're looking for the imbalance where demand significantly overpowers supply. The scales do this, aka price does that, explodes to the upside, as you are seeing here. You are then looking for when that change of character. So this is kind of, I'm going to go all Newtonian physics on you. This is an object in motion, then stays in motion until acted upon by a superior force. So here you are then looking for the change of character behavior around the key moving averages to indicate the change of trend. So you can see here what I call a bearish synchronicity candlestick. It's a widespread candlestick, takes out the 10 EMA. Next one takes out the 21 EMA, decisive gap down through the 50 SMA, and look how the volume is increasing here as well. Things to be paying attention to. So what Charles is saying, he actually prefers upside reversals on heavy volume, because if you think about where he's doing it, well, he's doing it around, say, the 21 EMA on a pullback or the 50 SMA. The heavy volume, if you see a gap down reversal bar, a shakeout demand tail, what he would call an upside reversal on heavy volume, is indicative that large operators are stepping up and supporting the stock at that level. What I would also say, though, is for me and my kind of Richard Wyckoff background as well, supply and demand, is I wouldn't mind if it's on low relative volume, because it's just saying there ain't much supply coming to the market. And bloody tastic in my view. But again, awareness of yourself, awareness of other market participants, what are they doing, where are they doing it. This one here is Skyworks. So similar time period, so builds this cup and handle, kind of then a high handle, but then the stock starts basing out here and you get multiple upside reversals. So what bar is this here? See how it gaps down to the 21 EMA, holds and reverses. That's an upside reversal bar. What moving averages is it holding? The 21 EMA. Where do we expect large operators to step up and support the stock? The 21 EMA. You can see it in here. You can certainly see it in here. See how the shakeout demand tail perfectly touches the 21 EMA. Then over here, upside reversal bar. Look at this little hammer candlestick. Look at this little shakeout demand tail. And what do you notice about the volume? There ain't much volume. What does that tell you about supply? There ain't much supply. And then you get another upside reversal. But this bar for me is a gap down reversal bar. Prior closes here, gaps down underneath the 21 EMA, then recovers. What do you notice about the volume? It's below the 30-day average. What does that tell you about supply? There ain't much supply. But here would be your kind of conventional pivot. So if you bought there, well, you're probably shaken out on this bar here, right? And then it tightens up a second time, and then you get this really tight bar. If you watch some of the other videos, you'll know I talk about trigger bars, really tight inside doji candlestick. Look how the volume dries up. Then the breakout comes through. But you see the games that are going on in the base. Gap down reversal bar, shakeout demand tail, shakeout demand tail, shakeout doji type bar in here. Then it tightens up. So again, shakeout, 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 shakeouts. They happen in the bases. Be aware of them. This is a little bit different. Very important, a little bit text heavy. I will let you read the text while I just talk about it. What Charles is basically saying here is you can think about pullback. So you can see Shopify here. It builds a nice big base coming through. So kind of big phase one accumulation type base, then moves into a phase two uptrend. Okay. What he's saying is supportive action can be around the key moving averages, as we were just looking with Skyworks, we were looking at Lululemon, but it can also be when a stock breaks out and then pulls back to a previous resistance area. So case in point, this one here is pretty good. So see how Shopify here is powering up here, and then it has a breakout around $26.5, $27, okay? So it breaks out here, decent volume, decent price action coming through. Look at all the 52-week highs. This is a free tool on TradingView. Search my name in the indicators. You'll find it, Jack Rosellis RS line. It's really good, really helpful. Just pin it to the bottom of your charts like this. So it breaks out, pulls back, and then it actually goes and puts in an upside reversal to the prior base high, which also is a confluence with the 21 EMA. Interesting. So here as well, you can see it then breaks out through this level of about $28, moves higher, pulls back down. Where does it find supportive action? Around the highs of the prior base. Interesting. But this final time over here, it doesn't hold. Look at what I was calling the bearish synchronicity. Look at the increasing volume coming through. Look at the deterioration in the relative strength. So you want to be looking, and why does this matter up here? Who's doing what up here? Who's doing what, guys? Bearish synchronicity, stock is pretty long in the tooth. It's just run from this kind of phase one base. You take an average through there of $16 up to $40. Look how many bases you have as well. This is the base count, that when you start getting 4th, 5th stage bases, they get very, very, very failure prone. So suddenly when you start seeing these widespread candlesticks on these Can Slim, true market leader type stocks, the volume is increasing, and it's just like a hot butter through knife, slicing through the 21 EMA, slicing through the 50 SMA. Are you now seeing a change of character? Yes. Should you be aware of that? Yes. Should you maybe do something about that? Certainly if you're still holding a position. Most likely, right? So, upside reversals. Uptrend add spots. After the breakout, once a stock is in a defined uptrend, there's going to be additional areas of support where you can define your risk, so it's not absolutely necessary to wait for an upside reversal in those cases. So the moving average lines that I pay attention to when a stock is in a defined uptrend are the 10-day moving average. On my charts, I use the 10 EMA. So even when I'm doing these video presentations, I don't like to change my moving averages because I want to see everything how I see it. 10-day moving average, 21 EMA, and the 50 moving average. So 10-day moving moving average guidelines, typically too close to price action except for very powerful stocks. Remember I was talking about earlier. Use the 10-day EMA and upside reversals off this level for small pyramid buys only. Got a really good example on Tesla. I think it's on the next slide. Use more as a means to keep you in the stock as opposed to an area to accumulate shares. When we get into the optimizing profits phase of the presentation, we're going to talk about using the 10-day moving average or the 10 EMA to keep you in the short/intermediate term trend. 21-day EMA. Many stocks abide by the 21-day EMA for an extended period of time. Use pullbacks to the 21-day EMA and upside reversals to accumulate shares. Many pullbacks to the 21-day EMA will be 10 to 15% off their high, which is sufficient to pyramid more aggressively than buying off the 10-day moving average. Remember Charles was saying the sweet spot is in kind of the higher teen areas for pullbacks that he's looking for. So i.e. a stock peaks, pulls back into its 21 EMA, he would like the pullback to be in the high teens area for more of the sweet spot. 50-day moving average guidelines. Classic support area most leading stocks will revisit multiple times during a big run. Often contains the entire advance of some of the biggest model stock leaders. Let's start going through some examples of the 10-day, the 21-day, and the 50-day. Say you start getting some reps and sets in. So this is Tesla. Now you can see multiple times Tesla breaks out, good reaction to the earnings, multiple tight candlesticks on high volume or low relative volume is a signal that there is either absorption of supply or there is sweet FA in terms of supply coming to the market. Then Tesla goes pretty much parabolic. Well, Tesla does just go parabolic here. Okay, it goes up over 106% in 10 weeks. And look how it pulls back into the 10 EMA, which is this black line. 10 EMA, 10 EMA, 10 EMA, 10 EMA, 10 EMA. And then decisive break of the 10 EMA. This is the change of character point that you've got to be aware of. When is a stock acting abnormal, or when is a stock acting normally and abnormally, or just basically understanding normal stock behavior? What does a strong stock do in the context of an uptrend? What does that strong stock do when it starts breaking down? You want to do this very, very, very deliberately. I cannot stress that point enough. But Tesla here, Charles Harris made about 80% of his gains in 2020, where I believe he was up about 1,400%. He made 80% of his gains in Tesla. And then see how it just rides the 10 EMA here perfectly. Now I'm skipping ahead a little bit to the optimizing profits part, because when Charles talks about the optimizing profits part, there is no kind of definitive answer, and he says that in the quote that I've got for you. There's no definitive answer, but we're skipping ahead here, but we'll catch ourselves up a bit later. What I would say and what I do myself is I like to try and stay in for the 10 EMA, but if I think price starts getting extended from the 10 EMA, especially if you see climactic behavior like this, look at the huge volume coming through, okay? This is not Nigel and Dave active here. These are the large operators active here. Are they accumulating? Are they more likely distributing when the stock's just gone on a run of 160%? What do you think? So what I find is a very effective strategy for myself is if price starts getting extended from the 10-day, starts looking climactic, I will go lower the bar, and choke it off that way. But we will talk about it in the optimizing profits part. Let's go on to net. So when you finally get that break of the 21-day EMA, you can reverse some of these shares and make a decision. Do you want to hold your stock, your lower stock? I had a stutter then, that was really bad, do you? I'll keep it in. Do you want to hold your lower cost stock? Do you want to take your profits in the stock, or wait and see what happens at the 50-day moving average? So what we can see here is the change of character point. So we can see that net Cloudflare breaks out of this base, finds support of action, upside reversal on what moving average? The 21 EMA, which is what line? The blue line. Then we have it again in here. But then look, a decisive break at the 21 and the 50. These change of character bars around the moving averages, you have to be very, very, very aware of. Buying the weakness on upside reversals is going to give you a much lower cost basis than always adding at new highs. And you can see if you were trying to trade net through the highs, okay, it kind of worked at this time here. Again, this is really V-shaped for me. I don't think that's kind of proper base, but even here, if you were like buying it through here, we probably got knocked out on this shakeout demand tail underneath the 21 EMA. So if you were buying through here, you probably got shaken out in there. It's not, again, it's not that kind of easy. Then do you see this gap down reversal bar, by the way? I know I'm talking about this a little bit. Okay, the 200 SMA is an area, so much of trading is awareness of yourself and awareness of others, and then visually seeing that on the chart. Who do you expect to do what and where? So if you see here, net puts in this gap down reversal bar on the 200 SMA very soon after earnings. A stock having a gap down reversal bar in the context of building a big base, then when it starts breaking out of the base, Bayesian way of thinking, update your decision making process when new information becomes available. So when net is then tightening up here, and look how that pesky volume dries up as again. See how the volume dries up, see the tightness in price coming through. Interesting. See the improvement in the RS line. And then here you're looking back and going, stock didn't break the 200 SMA. That's a longer term support average where you'd expect large operators to step up and support the stock. So you see prior closes here, gaps down, the open is the lower the bar pretty much onto the 200 SMA, then reverses. Then you get another gap down reversal bar here. Then you get another gap down reversal bar here. See how effective and understanding, especially on these TML, can slim type stocks, the importance of gap down reversal bars, but where they're happening in the context of the stock. Context. Really, really, really bloody important. Zoom, 50-day moving average. So the stock finally has a decisive break of the 50-day moving averages, which is a very ominous sign and definitely important technical sell signal. But I would say if you have a large cushion on the stock and it's still midweek, if you have the cushion and the stomach for it, it would make sense to at least sell part of your position, some of your position, especially after it's already tested the 50-day moving average successfully a number of times. So we're talking about this point here and these successful tests coming through in here. Moving averages a number of times. You might want to wait until the end of the week to close out your position, because oftentimes the stock will look terrible intra-week, but by the end of the week it actually turns out to be an effective shakeout. So if we take a look at Zoom here, okay, Zoom builds this nice big phase 1 base. Look at I call this bullish synchronicity, so it's the opposite of bearish synchronicity. See this bar coming through in here, okay? Widespread, gap up, open on the low, closes strong. Look at the volume coming through. It's just eyeballing it, maybe 5-6 times the 30-bar average. Who do you think is doing what there? And then look at the tightness in price. Tightness in price, low relative volume tells you what about supply and demand? There ain't much bloody supply coming to the market. And then you get this cup and handle type pattern. Okay, then it starts breaking out. Now it's chopping around all over the place. This is Q1 of 2020, okay? VIX is going like this, but Zoom is showing a tremendous amount of relative strength. The market does not miss the best opportunities. There are too many smart minds that operate in the market to miss them. They just don't trust the market. Look at the 52-week highs, back to back to back to back to back. Where does Zoom find supportive action? On the 50, on the 50, on the 50 pretty much. Gap down reversal bars. Shake out demand tail. So upside reversal, upside reversal, upside reversal. But we're talking about this point here. So see, you get this decisive break at the 50. But this happens on a Tuesday. And then by the end of the week, 1, 2, 3, 4 sessions later or so, prices actually recovered back above the 50. Interesting. Here is a obviously much more decisive break of the 50. Leg it. Look at the increasing volume coming through. Bearish synchronicity. Who's doing what here? They're legging it, the big old boys. So I'm going to show you this chart here of Zoom now on the weekly chart, and specifically at this point here. So then when we go and look at this point here, do you see how on the weekly chart the 50-day moving average on the weekly chart is the 10-week simple moving average? Do you see how on the weekly chart actually it's a little shakeout demand tail and there isn't much volume to really speak of? So does it look overly distributional? So this is Charles's point. If you have a very good cushion on the stock and then you get a close below midweek, okay, maybe take some off of the table, but actually potentially wait for the end of the week. Kind of see how the stock acts. Does it recover back above the 50? Because sometimes, as he's saying, you can get stocks Monday, Tuesday look really weak, take out a moving average such as the 50-day, which I'd say is much more important for a stock like this than thinking about the 10-week. But by the end of the week, it's actually recovered, as you can see here. But here, much more decisive break of the 50, which ties in with these bars coming through here. But see how it gaps down below the 50. Terrible. Look at the increase in volume as well. So a few more for the 50. So this is ticker SE, and this is on the daily chart. So you get this pivot breakout here. What chart pattern do you see? I see a cup and then a handle. See how it tightens in the handle. Look how the volume dries up. Look at the 52-week highs. The market just doesn't miss the best opportunities. So it's a great place to add to positions if you can tolerate the pullback to the 50-day moving average. One of the benefits of swing trading around a core position is that by taking some profits into strength, we're going to come on to that a little bit later on, you have a little bit more comfort when a stock is pulling back to go in and recover those shares you sold higher because you've already locked in some of the gain. So here you can see this is an upside reversal bar, holds just above the 50. So this is your first pullback to the 50-day moving average, ending in an upside reversal. Didn't quite get there to the 50-day moving average. Nearly did, but it got close and ended up in an upside reversal, and that would have been an appropriate place to try buying on the weakness. At this moment, the stock was 17% off its high at the close. So from this point here down to here at the close, 17%. Remember what we said about the sweet spot being in the high teens that Charles is looking for pullbacks. Then where does it get support? On the 50, on the 50, on the 50, albeit these are not upside reversal bars. But we'll talk about that because Charles will sometimes try and buy a stock as it pulls back into a key moving averages such as the 50 and not wait for the upside reversal, but we'll get onto that. This is PDD. So remember I've been blabbering on about upside reversal bars, right? Well, again, it's understanding where are you expecting large operators to step up and support the stock. Well, a stock like this, first pullback to the 50 SMA, you'd be looking for them to step up and support the stock around the 50-day moving average. What are two candlesticks that you could be looking for? Gap down reversal bar, as I call it, or a shakeout demand tail, which results in an upside reversal. So here, you see how the prior closes here, gaps down below the 50. What are a lot of weak hands doing? I'm out of this stock, I'm running for the hills, it's gap down, it's below the 50 SMA, run. Well, what does it do by the end of the session? Oh, gap down reversal, upside reversal. Make sense? Interesting. So awareness. Where are people doing what on the charts? Especially the large operators. So this slide here shouldn't really come as a surprise to you, because what type of stocks is Charles Harris looking to take? Well, he was schooled by William O'Neill. If you haven't read William O'Neill's book, How to Make Money in Stocks, you absolutely must. It is just the Bible on growth stocks, and his cancelling methodology is absolutely bloody fantastic. Go and read that book. It is worth £10, £15, however much the book costs. It's worth its weight in absolute gold. So this one here, I think the really big money in the market is made identifying the true big winners, the special high conviction stocks that have something truly special that can truly change the world, then capitalizing on those moves, which might be multi-year trends. What I try to do is try and maintain a core position in those types of stocks, but trade around the core by selling into strength when I think the stock is extended, and taking advantage of weakness to add to my position or recover shares that I sold in strength. We're going to get into kind of selling and stuff like that. We're going to talk about it in the optimizing profits part for selling part into strength. So this is Celsius here. I just think Celsius at the minute, it's a really interesting stock. Some high quality funds are busy. You got shares outstanding, only 77 million. That's good. Look at the RS lines. What chart pattern do you see? I see a big cup and handle. Looks like a huge cup and handle on the weekly, by the way. See how Celsius here is putting in higher lows and these big, shakeout demand tails, upside reversal bars coming from the weekly chart, albeit very volatile to control any risk. And this black line here is the market. So what is the market doing? Well, the S&P 500 is making a series of lower lows and lower highs, whereas what is Celsius doing? Well, Celsius is basically doing the opposite. It's putting in, importantly, higher lows when the index is making lower lows, and it's trying to make higher highs. Isn't that interesting? And then we take a look over here. Good estimates coming through with the guidance up as well. Earnings per share estimates for next year, 50%. Then take a look at the sales here. So I'm just blabbering on about some of the fundamentals. I'm sure Charles pays extremely close attention to this, but this is a really important point. So when you look at the sales here, ideally you want to see sequential growth, which is basically a fancy name for accelerating and increasing on a quarter over quarter basis and a year over year basis as well. So these percentage change figures are on a year over year basis, but you could break it down and look on a quarter over quarter basis. So if you look at the sales here, which is in millions for Celsius, 8 quarters ago, the company, in terms of their sales, their revenues was 65 million. Next quarter, 94 million, then 104 million, 133 million, 154 million, 188 million. Okay, little drop here to 178 million, and then 259 million. Absolutely huge. So you generally have sequential growth year over year and quarter over quarter. That is fantastic. Now, earnings have been coming in and missing somewhat, but take a look here. Most recently reported quarter, earnings up 344%. That is ridiculous. This is fantastic. And the stock is breaking into all-time high territory. Ridiculous. These are the kind of stocks. Celsius as well. Develops and markets functional calorie-burning fitness beverages. Do you know any other drink that burns calories from drinking it? Other than, I know some of you may go, well, green tea, it boosts your metabolism and stuff like that. You're kind of missing the point. Go and research what this company does. And at the minute, I believe it's only in the US. Wait till it goes global. You walk into a petrol station or something like that in the UK, what do you see? You see Monster Beverage, you see Red Bull. I'm not seeing any Celsiuses yet. There's a huge market for this. It is a global product. I think this is Celsius, really interesting. Keep an eye on it. Stock also has a history of being able to run and run hard as well, i.e. trend up hard. Anyway, that's enough on that. Market Smith are the sponsor of this video. If you're interested in a trial, there is a link in the comments below. Here we go. So, should you wait for an upside reversal? So, should you always wait for upside reversals when you're buying a pullback? The answer is not necessarily. You don't have to. But to be honest with you, I think if you decided to insist on an upside reversal when buying a pullback, I think you'd do tremendously well. I don't always wait for an upside reversal. I'll sometimes buy a stock that's coming into support, but it's not for everyone. It's more stressful and it's more difficult because when you wait for the upside reversal, that in and of itself is an indication of support supportive action. When you buy a stock that's come down to support but doesn't look strong and it looks weak, maybe closes at the low of the range for that day and or week, you're not seeing support action yet. All you know is it's come down and it should get support, so that's a much more difficult buy, and I would say it's probably a riskier buy, but you have to do what you're comfortable with. So Charles will buy as stocks are pulling down to their 50-day moving average without necessarily waiting until later on in the session towards the close to go, yeah, it's an upside reversal bar. So for me, gap down reversal bar, shake out demand tail. So here, Tesla's pulling down to the 50-day moving average, holds it perfectly, but it's not actually an upside reversal. So for you guys that are watching this, number one, you probably have a life, you probably have a job, you probably have family commitments as well. You may not want, what I'm basically saying is you may not want to stare at your screen all day. So you may actually want to wait for last half an hour, last hour of the market, last 15 minutes to go, here's a stock I'm looking, it ticks all of the cancelling criteria I'd want it to see, it's got great relative strength, I've been watching it for a couple of weeks to maybe pull back into its 50 or its 21 EMA, okay, 30 minutes to go, 15 minutes to go, yeah, it's putting in an upside reversal, then we'll come on to it a little bit later, oh, and now the risk makes sense. What Charles is saying is he will actually start buying as the stock is pulling back in to where he is expecting it to find support. That is not for everyone. That is much more for an active trader, but as he says himself, it's a much riskier buy because there's no indication of supportive action yet. It's just a stock going down. But what he'll do is he'll buy a small part of his intended position, and then he'll start increasing that as it starts coming down to the support area which he is intending. So that could be tying in with the high of a prior base and the key moving average. So here, Tesla's coming down to the high of the prior base, so resistance then should act as support is what you'd like to see. Oh, and it's a confluence with the 50-day moving average as well. But that there is again, it's a much more difficult buy. So I'd say if you're watching this, really think about, do you just want to wait for the upside reversals basically? And is that going to fit in much more with your lifestyle? For if you're thinking about this strategy and thinking about ways to potentially implement it rather than staring at a screen all day and kind of guessing, I think the stock will get supportive action, scaling into your position. Again, things have to work for you, have to work for your personality, as you'll see as we progress a little bit on. And certainly if you go and watch that Charles Harris video as well. A disadvantage of upside reversals, sometimes the daily spread is so great on the upside reversal that you don't definitively know you're wrong until you're down over 7-8%. So those who have read William O'Neill's book will know he had his max loss kind of in terms of stop loss at 7-8%. He said you should not take losses greater than 7-8%. So you might have a really wide daily spread, and if you wait for the stock to undercut the intraday low of that, being the upside reversal bar, so take out the low here before exiting, you might take a much larger loss than you were planning on. So again, the risk control, the risk element, we're going to go through a couple of examples where I really get you to think about is, okay, you're seeing an upside reversal bar, but is the risk versus reward favorable? Is this a favorable trade to be taking? And it's absolutely fine to go, I don't think it is favorable. And I'll give you a metric that you can be judging it off as well. So 3 entry techniques to buying weakness. So this is talking about not waiting for the actual upside reversal. As far as buying weakness without waiting for the upside reversals, this is more kind of intraday. There's 3 ways to do it. Buy when the stock is falling and approaching a support level. Buy after the stock hits a level of support and appears to stop going down. So again, this is very active. This is intraday kind of stuff. Buy after the stock begins to move back up after stopping at a level of support. So i.e. intraday, the stock's pulling back down to the 21 EMA and you're looking at it. So you've got, say, the daily chart here and you've got, say, the 15-minute chart or the 5-minute chart here as well. And then you see on the daily chart, okay, it's pulling back into the 21 EMA, and then you see on the 5-minute chart, okay, it's touched it, it's starting to reverse. That may be a time where you want to then start initiating a position. Again, that is for much more active traders, those who can kind of stare at a screen for the majority of the session as well. Each of these methods has its advantages and disadvantages. Advantages: easy to accumulate shares. Why? Because there's a lot of selling going on. Potentially a better cost basis. Disadvantages: catching a falling knife. Stock may not get support and continues to fall. So it just does that, kind of bounces a little bit off, say, off the 5-minute chart or the 15-minute chart, and then like that, and you get stopped out very quickly. So things to think about. No strategy is perfect. No implementation of the strategy is perfect. There are pros and cons, advantages and disadvantages to everything. 3 keys when buying pullbacks. So be patient and wait for the stock to approach support levels. Defining your risk is paramount. Discipline trumps conviction. So now we're going to go into the type of candlesticks, and I'm going to teach you a little bit about gap down reversals and shakeout demand tail. So these are not in kind of Charles's videos. These are a little bit of my own terminology: gap down, reverse bars, shakeout, demand tails. But I hope it helps me explain to you a little bit more on upside reversals, because if I can put it in language that makes sense to me, then I think I can kind of teach it and coach it to you a little bit better. So it's important to understand what these candlesticks mean from a supply and demand perspective, and where they happen in the stock in the kind of context of the price cycle. So is the stock breaking out of a base? Is it in a base? Is it trended? Has it topped? Is it in a phase forward decline? So on and so forth. So thinking about these upside reversals in relationship to the key moving averages is important. Why? Because there are areas on the chart we'd expect to see large operators step up and support the stock. Most notably 10-day EMA for the really quick ones, but certainly the 21-day EMA and the 50-day EMA as well, especially if the stock's kind of broke out, pulling back in, maybe it's basing in an uptrend, whatever. So let's start going through it. And we're going to start with gap down reversals. So this is from the IPO of RBLX, probably a stock many of you are familiar with. So gap down reversals, GDRs, can indicate the presence of large operators. Certainly if you're thinking about the CanSlim type stocks, the TML, so the true market leaders, where you'd be expecting the bigger boys to be playing, and guess what? Trying to shake out weak hands and accumulate shares as cheap as they possibly bloody well can. It's preferable if the opening price of the gap down reversal bar is near the low of the day. Why? Because it shows a more immediate presence of demand. The two things large operators require above everything else. Two things large operators require above everything else: liquidity and perceived value. That's the two things. It's liquidity and it's perceived value. So if you take a look here, again, we're going to start going all a little bit supply and demand woo here. So you see this. This is a gap down reversal bar, okay? See how the prior closes here. The prior closes here. Now, what does it do here? It gaps down on the open. There's a little shakeout demand tail. Then it closes strong. Now, is the low of that bar violated at any time during the base or as the stock starts setting up here? No, that's really bloody good to see. When you see these gap down reversal bars or these shakeout demand tails and the lows of those are never violated. Because if you think about Charles's strategy, well, what he's trying to do is basically buy upside reversals, which in my head are gap down reversal bars, shakeout demand tails, and the low should not be violated. Like if you were trading through a conventional pivot point, you wouldn't want to see the low of the pivot be violated. Why? You're wrong. There's more supply coming to the market. So these lows of the upside reversal bars, the gap down reversal bars, the shakeout demand tails should not be violated. Okay, we then start going, we get a really good reaction to the earnings. So earnings comes out after the close on this day. So look at the volume coming through. See the volume? Now I call this bullish synchronicity. So you have high relative volume. It's about 3 times the 30-bar average or so, maybe a little bit more. This is a stock where the bigger boys are playing. The volume coming through on this day is circa 30 million. And if you just took an average of this stock here, it's about $71, $70 or so. Look at the candlestick. It opens on the low and closes on the high. This is bullish synchronicity. You have the positive price action being confirmed by the increase in volume, and it's a TML, it's a CanSlim type stock. So this is really good to see. So as much as on these gap down reversal bars, you'd like to see it gap down, open on the low, then recover strong. Same on these bullish synchronicity bars. It's footprints of the large operators. We're going to go on to footprints on the next slide. Then over here, this bar here is a gap down reversal bar. And what moving average does it gap down underneath? What's this purple line? It's the 50 SMA. Now, is the 50 SMA, as we've been going through here, an area where you might expect large operators to step up and accumulate? Yes. So is it really good to see a gap down reversal bar? So the prior close is here, okay? The prior close is at, what's that, $75, $76. Then it gaps down, it opens here at around $70, which is just underneath the 50 SMA. And then look, the open of that day is the low. So think about it logically. Supply and demand is really logical. It gaps down, it opens on the low of the day, then what does it do? Pushes up. And this is a stock the big boys are playing in. This is not Nigel and Dave doing this. It's not. It's the bigger boys. And then you get this shakeout demand tail, and then the stock breaks through this pivot and goes. And then you get some supportive action over here, as we're going to look at. So here we go. Think of volume as footprints, and we're now looking at shakeout demand tails using the RBLX example, and we're going to look over here. So think of volume as footprints. How do we spot the footprints of large operators? Abnormally large volume bars. The key is to then understand the interrelationship between the candlestick and the volume bar and where it's happening given the context of the stock, i.e. basing, pullback, climactic run, downtrend below key moving averages, etc. So you are detective, right? You're looking for the clues. I don't know why on earth I did that, but you are the detective. You're looking for the clues. You're looking at the interrelatedness between what is price doing, what's the volume doing, what's the context of the stock. Is it basing? Is it trending? Is it trending up? Is it trending down? What moving averages is it pulling into? How is it pulling into those moving averages? What the is going on basically? Okay, everything you're trying to link back from a supply and demand perspective and go, do the bigger boys want this? And then if you find spots on the chart, we go, I potentially got an asymmetric risk versus reward opportunity here. And then I'm expecting this to happen. That's then what you're looking for. So here, first pullback to the 50-day moving average, which as Charles Harris said earlier on, is an area where you would expect large operators to step up. So it breaks out of this base, first pullback to the 50. So note the volume coming through. First pullback to the 50-day moving average is an area where we'd expect large operators to step up and support the stock. Are you seeing evidence of supportive action? Are you? Well, the volume is there. Lower this bar here, so shake out demand tail, touches where and holds where? 50-day moving average, and then it's a doji. Doji tells you what? There is indecision between supply and demand, but someone with a lot of cash is stepping up and supporting the stock here, especially because it gaps down, then you get this doji. Then look here, you get this shakeout demand tail, which is an upside reversal bar underneath the 50, and then look at the volume. There ain't much volume. What does that tell you about supply at that moment in time? There ain't much supply. And then we'll talk about the risk a little bit later on. We've got some examples. So now, as we go, I'm going to give you a test at the end. Well, not a test. I just want to basically make sure that you're kind of learning something from these videos, right? Otherwise, why on earth are you watching them? So that's why I like to include these kind of charts, these questions, these quizzes, just to go, are you actually taking it in? And you may be watching Netflix, and suddenly when I go a quiz, people go, oh, a quiz. Now they'll start paying attention, right? So here we go. Let's test your knowledge so far. There's 10 spots on the chart. I want to see if you can identify, and if you want, let me know in the comments how many of the 10 did you get here, and then at the end as well, let me know how many you got as well. Hopefully these videos are helping you. So find these moments. What are we looking for? We are looking for footprints of large operators before the big base. So this here is going to be the big base. Okay, this is the big base over here, okay, around the 50. Before the big base starts building, can you identify the footprints? 21-day EMA shakeout in the continuation base. Can you identify the continuation base type pivot? Can you identify the continuation type pivot breakout? Can you identify the gap down reversal underneath the 50-day moving average? The shakeout demand tail underneath the 50-day moving average? The tight pivot on the 10-day and 21-day EMAs? The 50-day SMA as well? The tight pivot breakout, the short base breakout 1 and the short base breakout 2. I will give you 3 seconds to try and find them while I let my voice recover a little bit. So 3, 2, 1, here we go. Nice. So let's just start at the end. Short base breakout 2 is in here. Short base breakout 1 is in here. So the footprints, did you find the footprints? Here you go. Look at the massive bloody volume coming through. Guys, they can't hide their size. The institutions, when they want into a stock, they want into a stock. How do you find it? Well, you're looking at the volume, the interrelatedness with the price. You're then thinking about the context of the stock. Where's it basing? What are you seeing? Are you seeing gap down reverse bar, shakeout demand tails? Where are you seeing it? How is the stock tightening up? Are you seeing bullish synchronicity come through? Are you seeing heavy distribution, bearish synchronicity come through? You're going to see it at some point. You need to be aware of it. So the 21-day EMA shakeout demand tail in the continuation base is right here, and then the continuation base type pivot is right here. Remember what I blabbered on earlier about these multiple tight candlesticks on low relative volume is telling you what about supply. It's the Minovini point. There is no supply coming to the market. Volatility contracts invariably before breakouts, and you see it over here as well at 0.7. So then your continuation base type pivot breakout is right here. You have a gap down reversal bar underneath the 50. So see, prior closes here, it gaps down. And the lower the bar is what? The lower the bar is the open of the bar. So price gaps down and then it up it goes with the sound effects as well. Then it pulls back down. Then number 6, you get a shakeout demand tail right here. But look how the volume is starting to drop. And then you get your really tight pivot. Look how the volume dries up in the pivot. Isn't that interesting? Look how the volume and the tightness dries up for the breakout. Look at the volume and the tightness before the breakout. Look at the volume and the tightness before the breakout. Look at the volume drying up and the tightness before the breakout. And then up it goes. It goes up, what? This is at least 100% in, I don't know, 2 weeks, something like that. Pay attention. So control. Couple of quotes. With regard to cutting losses, there's 2 schools of thought of whether you act immediately or you wait till the end of the day. I think it's a 50-50 thing. I personally typically have the tolerance to wait until the end of the day depending on the intraday action of the stock. I prefer to wait towards the end of the day to see if there's another shakeout. So you can get like intraday shakeouts. You can get multiple intraday shakeouts. Some people act immediately, i.e. stop loss lower the upside reversal day. I think it has to do with your personality and doing what you're comfortable with. Charles actually has a very high degree of risk tolerance, I would say. Prior to the stock breaking out of a base, the only way you can really define your risk is by waiting for an upside reversal, because when a stock is still forming the base, it is typically trading below moving averages, and those moving averages may not even be trending up, so you can't really rely on them. It's crucial to be patient enough and wait for an upside reversal when you're buying before the breakouts, i.e. in the base. The upside reversal in and of itself is supportive action and allows you to easily define your risk, so insist on waiting for that before you take a position. Here we go. So we're now going to start going through some examples, because hopefully you have a pretty good understanding of upside reversals, what type of candlesticks you are looking for, shakeout to martels, gap down reversal bars, and moving averages that you would like to see a stock holding on pullbacks and or basing action, and what you would like to see. So those who have studied the works of William O'Neill and his cancelling methodology, the How to Make Money in Stocks book is absolutely fantastic, worth its weight in gold in my view, will be familiar with the 7 to 8% max stop loss cutting rule. As a reference guide, looking at the stock's ADR, which is the average daily range percentage for the past 20 days, can aid in keeping the risk versus reward ratio in check for upside reversals. Now, Charles does not talk about the ADR percentage and average daily range. For me, I just find this a helpful concept, and hopefully it helps you in terms of thinking about the risk versus reward. Is it favorable to really keep it in check? So we have PDD here. So this is the first pullback to the 50-day. And what do you notice? What bar is this? It's a gap down reversal bar. Prior closes here, gaps down underneath the 50 SMA, and then recovers. So imagine if you're looking at this with 5 minutes to go or something like that. So let's just imagine that the price is here at 78.95, and you're like, it's an upside reversal. First pullback to the 50 SMA. The stock is what's that, maybe 15, a little bit more percent off its highs, or something like that. My maths isn't very good when I'm kind of just mentally destroyed myself for the last hour or so, but let's say the pullback here is within the sweet spot, kind of the teen region, so it's pulling back in here. Then you get this gap down reversal bar on the 50 SMA, so you're like, I could enter the stock here at 78.95, place my stop penny below, which is 75.99. That would be 3.75% risk. Then we go here and we look at the ADR percentage. Search ADR percentage on the likes of a TradingView. You will find it. You can get in the likes of TC2000 as well if you want as well. So the ADR percentage here is for the stock, let's imagine at this moment in time, is 4.14%. What on earth does that mean? It means the average daily percentage move for the stock over the last 20 days is 4.14%. So a good risk versus reward kind of check is my initial stop loss less than the ADR percentage of the stock? That there can just help you in terms of gauging, is this a favorable risk versus reward trade? Do a few more reps and sets, hopefully it will start making sense. So let's say with Tesla here, you now go, it's a gap down reversal bar, so it's an upside reversal around the 50 SMA where it's held previously. But now if you were looking at this with say 5 minutes to go and you're like, it's an upside reversal bar heading into the close, I could enter at 129.26, place the initial stop penny below 117.09, but I'd have to take 9.42% risk. I mean, that's already above the 7-8%, and then if we imagine that the ADR is 3.62%, it's nearly 3 times the ADR of the stock. That trade you really want to be taking over the series of 100 trades, 500 trades, 1,000 trades? For me, the answer is no. I like to keep initial stops less than the ADR percentage to really keep that risk in check. A few more. So we've got Zoom and we've got 2. So let's imagine that the average daily range over the last 20 days for Zoom is 3.37%. Okay. Here, we pull back into the 50-day. So imagine you're then looking at this and you're like, it's an upside reversal. Bounce off the 50-day in here. Go in, 122.94 is the entry, 108.52, initial stop, penny below the low of that bar, well, it's 11.73%. Well, it's over 7-8% William O'Neill rule, and it's huge. It's nearly 4 times, roughly, the ADR percentage. If we're imagining if this is the ADR percentage at this moment in time, granted, it would be a little bit more. This is today's ADR percentage when I was taking the print screen. I can't run this back here, okay? But here, the risk, it's all out of whack. It doesn't make any sense. So you can get these pullbacks to say key moving averages, 50-day, 21-day, stock could be basing and you see the upside reversal, but the risk just doesn't make sense. And that is the patience element. It was, as Livermore said, the big money is made in the sitting, both in terms of sitting when you're then in the stock, but sitting and waiting for the correct opportunities to come along as well. Patience, 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 and have even more patience. It's so important. Nearly swore there. It's so important. Then over here, well, now you get this upside reversal, bit of a confluence because it's underneath the 21 EMA, comes down, nearly touches the 50, closes strong on the high. See how it closes on the high? Even better indication of strength if the upside reversal bar is closing on the high of the day. It's just better indication of strength, isn't it? But here, 8% initial stop. Do you really want to do that? Especially if the ADR is 3.37%. So again, this is why Charles will then implement things like as prices pulling back down. So here you could see that, well, it would have been really effective if he was buying parts as it was coming into the 50, buying parts as it was coming down this day with the expectation that it holds around the 50. Again, there's advantages, there's disadvantages to different implementations of this. Shopify. So now we have one here, and we're going to say that the ADR percentage is 4.35, and then we see that Shopify, look at this on the little side point. I've spoken a lot about gap down reversal bars. Even better if you get a gap down reversal bar in the earnings. That's a nice shakeout. So you see here, this is Shopify on the earnings. And again, context, right? It's not just a gap down reversal bar. Think about the context. Shopify is in a strong uptrend. Look at the 52-week highs coming through. Prior closes here, okay? Prior closes here. Gaps down to here underneath what moving average? 21 EMA. Little shakeout demand tail, recovers, volume 3-4 times the 30-day average. What do you think large operators are doing on this bar? What do you think they're doing? Do you see the importance of gap down reversal bars? And then we trend. Here's a gap down reversal bar, a couple bars later. Trend. Oh, gap down reversal bar onto what? The 21 EMA. So the prior closes here, gaps down, opens here, closes on the high. Now, if you were like into the close, you were like, I could go in $19, stop, 18.09, penny below. That's about 4.82% risk. And the ADR is 4.35%. Okay, maybe that's acceptable because it's sub 5%. It's pretty darn close. It's in about 0.5% of the ADR. It's a nice one. You got the context of the gap down reversal bar on the earnings. So this is one where you're going, okay, yeah, I think it is in check. Sub 5%. Look, it's 52-week high. Even on this gap down reversal bar, the stock's putting in a 52-week high. Stupidly strong when that happens. ACLS. So here you have a gap down reversal bar. So the stock is basing. And then do you notice, what does it do 2 days before it breaks out? So before it actually breaks out, what does it do 2 days before? Huge gap down reversal bar. Do you see the importance of thinking about gap down reversal bars and the games that happen in the bases and in trends? It's really important that you're aware of this. Look here. This is the prior close up here, just underneath $32. Gaps down to about $28.50-ish. Gaps down, little demand tail, and then recovers. Isn't that interesting? And then it breaks out 2 days later. So had you bought this base breakout coming through here, which is around $30 or so, nice round number as well. Had you bought this base breakout coming through here, well, you think, oh, I'm up. Look at me, I'm up. 4%, 5%, something like that. Aren't I good? And then you probably get shaken out here. And then guess what happens? Round it goes. Off without you. Charles's point earlier on. The stock is trying to go higher with the least amount of people on it. You've got to be aware of these games. Gap down reverse bars, shake out demand tails. Here's another one. So this is net. Stock, good reaction to the earnings. Look at the positive reaction to the earnings. Bullish synchronicity, gaps up, widespread. Look at the volume confirming it, 52-week high. And then as the stock starts basing along the black and the blue line, which is a 10 EMA and the 21 EMA, shake out demand tail, also known as upward reversal bars. Shake out demand tail, shake out demand tail, shake out demand tail, really tight inside bar. Look how the volume dries up before it goes. This bar is telling you there ain't much supply coming to the market. But this one here, imagine if you were looking at this upside reversal bar at this time, and let's say the ADR percentage was 4.85. Well, does it make sense targeting it at the high here with a stop underneath the low? So you're targeting it at 28.20 with a stop penny below, say 25.84, where your initial stop is 8.337%. Does it make any sense? Not to me, because it's nearly twice the ADR percentage. I don't want to do that. So again, it's about understanding kind of the strategy, but also your risk tolerance. You may be an absolute cowboy and you may be like 8% risk, that's absolutely fine. Normally I trade penny stocks and my stop is 20%. Maybe you don't even trade with stop loss. But this is the point here. Risk is very, very personal. For me, I like to keep the risk as tight as possible. So I'm very aware of Charles' strategy because it's things that I look for in the base. I didn't call them upside reversals, gap down reverse bars, shake out demand tails. But for me, it's a strategy which it kind of really makes sense to me because I'm very, very aware gap down reversal bars, shake out demand tails, large operators trying to shake out the most amount of weak hands before the stock goes high. So you've got to be aware of the games the bigger boys are playing. Again, you could think, well, isn't this just manipulation? No, it's just a game. It's just a game. If you're going to play a game, it is for you to know the rules of the game. How are they playing it? Shopify. So let's imagine this one here. The ADR is 4.37%. And let's say you see this stock basing in here nicely, and then you get this bar here. It's an upside reversal. So it opens on it's a little gap down, opens on the low of the bar, closes on the high of the bar, and it also does it on fairly low relative volume. So I call this bullish ease of movement because price is easily moving to the upside on low relative volume. What is that telling you about supply? There ain't much flicking supply around, is there? So now does it make sense? Upside reversal bar, but now we can go in initial risk of 3.59%. So maybe you're looking at it towards the close. Maybe you're doing it with, say, a buy stop through the high of the upside reversal bar on the next session. Again, implementation, whatever works for you. You really got to think about that yourself. But here you could go in. It's 5 minutes to go. Upside reversal bar 414. Initial stop underneath, penny below. That's 399. Just underneath $4. 3.579%. That's good. It's nearly a percentage less than the ADR. It's really tight. Now that's looking like a better one, isn't it? Let's do another one. First Solar. Good reaction to the earnings. So earnings gets reported after the market closes. Here's the reaction. Sparks a nice uptrend. Stock pulls back. Then you get this gap down reversal bar, upside reversal onto what moving average? The 21 EMA. Interesting. Prior closes here. Gaps down just underneath the 21, then recovers. So imagine if you're looking at this with 5 minutes to go and you're like, upside reversal bar, good reaction to the earnings. First pullback to the 21. I could go in initial stop of 1.72%, targeting it at 92.99, initial stop 1 penny below 91.39. That's 1.72%. What's the ADR? Is 3.83%. Now that's favorable because that's around half the 20-day ADR percentage. Okay, so do you see how not all upside reversals are created equal? It's really thinking about your risk tolerance. It's obviously thinking about the quality of the setup, but as part of the quality of the setup, you're also thinking about the amount of risk that you're having to take. How much risk am I taking here to know whether I'm wrong or not? For me, I'd rather go in like 1.72% like an absolute chicken rather than an 8% stop loss. That's just me. That's my personal preference. ACLS. So we've got another one. So this stock here starts finding supportive action around its 50-day moving average, and then it puts in this upside reversal, shakeout demand tail right here. So let's say you were targeting it through the high, 49.70, stop, penny below, 47.49. That would be 4.5% risk. What's the ADR that we're saying? We're saying it's 5.01. Is that a favorable risk versus reward trade? Yes, it is in my view. And then when you're looking at this bar here, or you're potentially looking at where it gets really, really tight in here, look back. Where did the stock find supportive action? It found it on its 50-day moving average. Who steps up and supports the stock around the 50-day moving average? Interesting, the large operators. Where did the stock find support after the earnings gap and pullback? The 21 EMA. Interesting. There was also a gap down reversal bar on the 21 EMA. So this is one here where you may have bought this bar here. Okay, nice upside reversal bar, little gap down reversal bar as well. Buy it here, initial stop here, and then it goes for a couple of days. Then you would have got stopped out. But we're going to talk about the active risk mitigation. And if you've seen some of my other recent videos, you know that is a significant part that I give a lot of emphasis on. So a few more quotes and then we're into the mitigate section. There's nothing complicated about those rules to be a consistent winner. Cut your losses quickly, let your winners run, adding to a winning position, not a loser, trade in line with the market, don't over concentrate, predefine your risk, and so on and so forth. But it's one thing to know these rules and another thing entirely to follow them religiously on every trade. The interesting thing about trading is that you can follow the rules perfectly 99 times in a row and have huge success. But if on that 100th trade you violate one or more rules with a big position, you can unravel all your previous success in virtually no time at all. 99 good decisions wiped out with one really bad one. Probably 3/4 of my losses in terms of money were the result of 3 disastrous trades. 2 in Tesla and 1 in IKEA. I think that is how you pronounce it. I'm dyslexic and I really struggle with pronouncing things. What Charles is saying, out of all the money that he has lost in the market on losing trades, it's actually happened in 3 trades because of that kind of 100th trade syndrome, that is the time he didn't follow his rules. And when you don't follow your rules, the market will punish you. Mitigate. So Charles does not directly discuss active risk mitigation techniques early on in positions. Rather, he talks about selling parts of his position into strength, and we'll come on to that actually on the next slide, in the optimizing slide. Personally, I think prudently mitigating risk is important. Therefore, with a strategy like this, one could think about adjusting the stop to break even, say when the stock starts getting out, and or selling parts into strength. So you see here, this is Amgen. You get this upside reversal bar, which closes on the high of the bar, shake out underneath the 50 as well. So imagine if you were buying here, Okay, as the stock starts then moving out and powering up like this, well, if your initial stop was underneath the low of the bar, you could then start moving your stop closer to wherever your break-even price may be, which would be, so the higher the bar, but then also keeping it underneath the 21 EMA. So say on this day here, you bought this upside reversal, up here you go, well, the stock's now moving up, I could move my stop to break even underneath the 21 EMA, and or you could sell par. I've done some other videos on the channel where I actually take you through the free rolling math, so the risk mitigation math. For me, active risk mitigation really works for me. So selling part into strength to then free roll the trade, so selling 1/3 at 2 times initial stop on new stop. I don't want to go into it too much in this video as Charles doesn't talk about this, and I want to keep this video much more focused on upside reversal and Charles's video. But here as well, imagine if you bought this upside reversal, so see upside reversal around the 21 EMA, low volume as well. So imagine you're buying it here at, what's that, around about $1.55. This is split adjusted 101 times for Amgen, but imagine your stop loss is here. Well, when it starts moving up here and potentially when it actually starts breaking out, look at these multiple tight candlesticks and low volume again. Interesting. Remember what I said earlier, no supply coming to the market. So when it starts breaking, this is when you could be moving your stop loss to mitigate the risk by moving your stop loss up to break even, maybe slightly above as well. Now let's go into the optimizing side of things. So on when to sell, you could wait for a downside reversal before you begin to sell because your expectation is further weakness. So basically the opposite of a upside reversal. But on the other hand, other than that, maybe an extension over the 10-day moving average, the 21-day moving averages, or the 50-day moving average. But the most powerful stocks will defy that and get quite a bit more expended than you can imagine. So the truth of the matter is I don't really have a great way of doing it, and I don't think I could do it particularly well. Like Tesla, which had such an enormous run all last year, 2020. I was so cute with it, selling into strength and trying to buy weakness. But by the end of the day, I think I would have had similar performance simply holding the stock without a gigantic capital gains tax to pay. So much depends on your personality. However, in my view, so talking about me here, in my view, consider selling on closes below the 10-day EMA and or 21 EMA with the flexibility to go lower the day should price get extended from the 10 EMA. So these are my own sell rules, okay? For me, randomly selling into strength because I think a stock is extended, I personally don't think is optimal. I just don't think it's optimal. And for me, for my personality, I prefer more mechanical sell rules with the ability to override those mechanical sell rules. So what I am looking to do is early on in positions, free rolling it by invariably selling 1/3 at 2 times my initial stop loss, or maybe I'm moving it up. Great, now I've taken all the risk out. Then I'm trying to ride the intermediate term trend. Now the intermediate term trend for me is defined by the 10 EMA and the 21 EMA. However, if the stock gets extended from the 10 EMA like Tesla did here, where it just goes parabolic, running from like 260 to over 400, then here I'm going lower the day, 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 lower the day. You can go and look at this for yourself. So imagine Tesla here. Imagine you buy Tesla kind of coming out here, something like this. So your entry is like 265, something like that. Okay, you're buying it in here. Imagine on this day here, you're like, oh, it's gapping up, and it's like 320, and you're like, oh, I'm out of this, I'm selling this. And this is what I was talking about. He got so cute with it of thinking it was extended, and then it just continued to get more and more and more extended. I've been there myself 1,001 times, right? And for me, I then just put rules in place to go, well, extended stocks can become more extended. And for my personality, I have ADHD, so I tend to be just, if you have ADHD, it's actually a neurological disorder. It's not naughty boys in school. You just can never sit on the chair. I was actually very well behaved in school. But ADHD and people with an ADHD brain, if you have it, you may be able to relate. You're quite impulsive. So for me, actually, that impulsiveness of, oh, the stock's extended, I've got to do something. For me and my own trading rules and understanding my personality, I've got to take that out of the equation. So I do that 2 ways. I look for closes below key moving averages, but if I think a stock starts getting extended, I will go lower the day, lower the day, lower the day, lower the day. Now that's much more effective for me, my personality, and how my brain works, and understanding that I can be very impulsive in my nature. So I have to have those much more kind of firm sell rules than having kind of vagueness and grey and stuff like that. And that's just for me. So imagine here, if you entered at 265 or something like this, and on this day here it's gapping up and it's 320, and you're like, whoa, this is it, super extended here, it's not going to go any higher, I'm taking out my whole position. Yeah, well then it goes $80 higher over the next 2 weeks. But see how effective, even if this day here you were like, no, this is extended at 300, lower the day, lower the day. I'm going to say lower the day a few more times. Lower the day, 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 lower the day. You are taken out up here. Now, go and look at the moves Tesla had and then see how effective lower the day, lower the day, lower the day would be on the majority of them. Go look at other kind of classic CanSlim, TML, model book type stocks and see how effective that strategy is, and or waiting for closes below the 10 EMA. Now, this is a little bit of a special situation. Why? Because somebody of significance, i.e. Elon Musk, did a poll on Twitter the day before saying, should I sell about $5 billion of my Tesla holdings to pay my tax bill? So if you have the chief exec that is about to sell $5 billion worth of stock on the market, want to think about that. Now, clear change of character, that was actually then the top for Tesla. But for me, Charles, there's no kind of firm rules around that. It's more of kind of an instinct and a feel, and he's trying to buy on the pullbacks. But for me, I've just said to you why I use more kind of mechanical rules. Whatever works for you, basically. Understand your personality, have rules around that. So we are now at the end of the video. Pretty much. How long have we been going? Around about an hour and a half. So hopefully you have learned something at the end of this video. Now, before I reveal the answer, if you have made it all this way, if you're not subscribed to the channel, please do subscribe to the channel for more videos like this. Please do press the like button. It really helps me out. If you want to leave a comment with how you got on in these quizzes, or you have any questions, just let me know in the comment section below. I will do my best to respond to you personally. So, couple of things to spot. Can you spot the two positive earnings reactions? Hopefully they should be fairly easy, but here we go. This is now getting into it. Can you spot the 4 21 EMA upside reversals? Can you spot the 50-day SMA support and then the upside reversal bar? Can you spot the low mid pivot breakout after the 50 SMA support? Can you spot the pivot breakout after the 50 SMA support? Can you spot the climactic behavior? Oh, and look at this. First Solar was a model book stock. What if you went up here when you're like, well, this is stupidly extended? Lower the day, lower the day. Interesting. And then can you spot the decisive break of the 50? 3, 2, 1. I counted the wrong way. 3, 2, 1. Here we go. There they are. Positive reaction to the earnings in here. Positive reaction to the earnings coming through in here. Here's one. So 21 EMA, upside reversal, upside reversal. Here's the 50 SMA and then the upside reversal on the next bar. Here's another 21 EMA, upside reversal. Here's your low mid pivot breakout. Look how tight the price action gets. Here's the 21 EMA upside reversal, then your pivot breakout, then your climactic behavior, then your decisive break of the 50. So hopefully you got all of them, which will be absolutely super duper, because then you've learned something during this video, hopefully. And then finally on the mindset. Now, I am not going to do the mindset section of this video justice. You can read these out, these quotes for yourself, but what I would say now is go onto YouTube, which you're probably already on YouTube, and search for A Trader's Journey by Charles Harris. It's around about 90 minutes long. The kind of mindset section kicks in I would say around about the final third of the video if you just want to skip to that section, but I just would not do the mindset section justice. I think Charles is an extremely just fantastic human being, talented trader, and also down to earth and humble. So I think that video, now you've watched this video, would then give you a really good insight in terms of his mindset and the implementation of this strategy. So thank you ever so much for watching. I really do appreciate you guys watching the video, and I look forward to seeing you in a future video.